Hello everybody, thanks for watching this video. This is the lesson 5, part 1 of 3 of getting started in technical analysis. This is one of the most important topic, that's why it's been split in 3 parts, because as usual I'm trying to keep it short and easy to understand for everybody, I hope, and so I give you time to get confident with those topics and those concepts. And I would suggest, first of all, once after this video, just to practice a lot, just open any charts and try to find those reversal pattern. This is exactly the topic, today's topic, so it's reversal pattern. Or reversal indicators. So first of all, the main let's see how many patterns we know, which type of patterns we know in technical analysis before getting into it. So the main patterns are, there are 2 types of patterns: continuation patterns. Those continuation price patterns are just a pause, a stop in the trend, in the price movement, but after that the price will resume its trend. So perhaps if there was an uptrend, there will be some times where the trend will be sideways before resuming its uptrend. So it's bullish, but with some stops, some pauses in the market. Those are the continuation pattern we will see in more detail in the lesson 6. Now we will be mainly focused on reversal price pattern. They are very important because they are, if we will be able to find those reversal patterns, we will be able to understand and to see when the trend will change direction, so when the trend will reverse. This is very important because one of the goals of technical analysis is even the trying to find the right time to get into the market, so the right time when to buy and when to sell. With those patterns will help us, will give us an idea, actually will help us to understand the right time to get into the market, right time when to buy or when to sell, especially with reversal pattern, because if we are good to find it, and it means that we are able to find the starting of a trend, so it's good time, perfect time to get into the trend. The main one are 5. There are 5 major reversal patterns, but the most seen, most, the one that are easy to recognize actually are head and shoulders, triple tops and bottoms, double tops and bottoms. Even the spike of V-tops, it's easy to see. The rounding or saucer pattern is more complicated and it's not very often. But now we are going to have a look on head and shoulders. The head and shoulders is the main reversal patterns. All the other, like the triple tops and the double tops, are just some variation of the head and shoulders. Then something that all those patterns have in common is those 6 points. So all the patterns, all those reversal patterns has to have generally those 6 points. Those are some general rules, just to let you know, guys. Technical analysis, it's not an hard science. Hard science, if you don't know the definition, just Google it, but it's not something exact. It's not something that it's infallible. Actually, technical analysis can fail. It's failable, can fail. Again, it's just mainly based on percentages and probabilities. So it's something that it's based on probabilities. So perhaps 60-70% of the cases it works, on the other 30-40% it does not work. So this is important. Those are general rules that general worked for those type of reversal patterns, but they are not mandatory. So they are just some rules to help us to find the pattern, but again, they are not mandatory. If some of those rules are not respected, does not mean that the pattern is not going to happen, and vice versa. If all those rules are gonna be respected, it does not mean that the reversal pattern will happen. Anyway, those 6 points are very important. Just please take a screenshot, memorize those 6 points. So the first one is that there has to be a trend, otherwise we are not gonna reverse anything. So trend has to be there. There has to be a breakout of an important trend lines, and there are some rules like the larger is the pattern, the greater is the potential. So it means that higher is the pattern and wider, so with high volatility, and wider, so it's gonna very long time, perhaps couple of weeks or months. So this is higher and wider, more will be the probabilities that the market will reverse. So this is the concept. And again, if the market is even more volatile, it means that there are more opportunities to get more opportunities to get or lose again money because the margins will be higher. The fourth point is just generally regarding the top patterns, that they are generally shorter in duration and more volatile than bottom. So it's good because there are more margins. So because it is more volatile, there are more opportunities to get money. Bottom is bottom is generally a small price range, and it take longer to build, so it's longer than the top. And then the volume are important, but not mainly are important for the bottom formation rather than the top formation. But if the volume confirms the pattern, it's good. It's an added information that the pattern can happen. If the volume does not confirm the pattern, again, because it is only based on probabilities, it does not mean that the reversal pattern will not happen, and vice versa. If the volume confirms the pattern, it does not mean either that the pattern will happen. So the change of the price will happen. So because again, it's all probabilities and percentages. So let's move in more detail. Let's see. This is at the shoulders top. This is at the shoulders pattern. This is the top one. This is the formation. Once we will be able to locate this formation, we see that we have a head, left shoulder, right shoulder. This is the reason why it's called head and shoulders. So the main points are that the right shoulder E is lower than the right shoulder E. So this is a signal or weakness of the market where the right shoulder is not able to overtake the left shoulder. So this is can be seen as first weakness point. The other weakness point is that the trend line has been broken. Here it is. So this is a signal. So because this trend line has been broken, it might be a signal that something is gonna happen. Once trend line has been broken, one we have this point D that is gonna be formed below the point A. Why? Because it has to be below the point A, because sometimes, you know, we saw in trend lessons through the point A we can define sometimes a support for the new point D. So if the point D is below the point A, it means it's one more weakness point. So all those points together, we can understand, we can start understanding that the market is reversing, or there is something wrong in the market, let's say. Then once we got this formation up to the point E, it's possible to draw the neckline between the point B and D. Once we have defined the neckline, what we can see is that once we define neckline, we can see that the reversal pattern will be completed. We can see that most likely the market will reverse only if there will be a breakout of the neckline. So the breakout of the neckline has happened to this retracement price here between E and F. Generally, this EF is between 0.5 0.66 of this retracement CD, but anyway, once the neckline has been broken, so it can be really a good signal that the reversal pattern will happen. And then, as you can see, this C, D, E, F, G is just the start. This is just the start of a new downtrend. Sometimes there can be even the return move, the point G. It can happen often. It's no problem. And then once we have got this formation, we can define the target price. Target price is just the projection of the head between the neckline, this neckline, and just project this line from the breakout point. So this is our minimum target price, because generally when there is a reversal pattern, the maximum target price is even is all the uptrend that was before. Generally, that's why we are reversing the price to go back where it was before. So actually the major target price, it can be even all the whole difference between the previous trend line, the difference between the previous trend. So the minor target price is easy to be defined. Important stuff are the volume, not important, but if the volume respect those conditions that I'm going to explain to you right now, it's better. So the volume in point A, C, and E in the peaks should decrease, okay? And then this is important. This is one of really important. If it is happening, it's good sign. And then something very important, that when at the breakout point, once neckline has been broken, there would be high volume. Generally, the breakout happens with high volume. Just after or just even below the breakout, there would be high volume. And then again, once the point is once the return move, I mean the point G has been achieved, I mean has been created, formed, let's say, from this point, again high volume, and the price will go down. So again, the peak A, C, and E, the volume has to be decreasing, and then the breakout point high volume, just the breakout point as well, and then just after, and then again, those are the main concepts. And then once the point, this one has been created, it will go down anyway. The same. So all those information have been said here. So this is important. Please just take a screenshot. This is what just I told you right now. Something important, I want to go back 1 second, is this one. This is very important. So I mean, this one to be considered, that to be considered a proper reversal pattern, what we have to say that at least from 1 to 3% penetration has to happen. So at least the price has to penetrate the neckline at least from 1 to 3%. So there is another slide, another lesson where I was describing, guys, the penetration. So just please, if you don't know how to calculate it, just check in those lessons, you will find it. But this is important. So the penetration is gonna confirm that 1 or 3% penetration is gonna confirm, it's gonna give us more confidence that the market can reverse. So those points are important. Please take a screenshot, learn it. Again, this is the volume, as I told you before. This is minimum target price, as I told you before. Take a screenshot of this one, read it, go into detail, just please read it. This is an example of the just an example. I want to just show you that this is gold. The volume there was really weird, so the volume there at the breakout point was low, and even here was very low. In fact, this one, even if it looks like a proper head and shoulder, right shoulder head, it did not work. So in fact, the market kept going up. So it jumped down back, and now is keep going down. The market keeps going up. So this one did not work as reversal pattern. So that's why be careful. The volume is not confirming it, but even if it looks like a reversal pattern, it did not happen. There was a trend, uptrend there coming up. So the 6 points at the beginning were respected, I mean the majority of them, and then but the volume there is something wrong in this peak, in this volume there. So it could have been seen as a warning for us. This is another one where again this is happened. This is head and shoulder. It worked properly. It went down, even if the return move, is not like that up to this point, but generally it worked properly. So this is a sign that the return move can even go up to the neckline by gain. This is just an intraday, so it's not been broken by a couple of 1 day or 2 days. So as long as it's an intraday, we can accept it. We can accept a violation of neckline for an intraday. But if it was 1-2 days, perhaps it could be seen as a warning for us. Volume is not respecting the volume again, so that's why I told you volume it's not mandatory, but it's better if they are there, but it's not mandatory. This is exactly the same, guys. This is exactly the shoulder bottom. It works totally the same. So please, that's it. It's just the same condition. Target price gonna be calculated the same. This is 1-3% percentage of retracement. The volume. The only difference is the volume has to be much higher at the breakout point. Really higher, like this one. After the breakout point, the volume has to go up because it's more important for the bottom of from the bottom of the and the shoulder. It's very important because it's easier for a price to fall down rather than a price to go up. It's like gravity. So a price that is at the top, it's easier to fall down, while a price that is at the bottom, it's more complicated to raise up. So it needs more pressure from the buyers to go up. So this is the reason why the price has to be so high there. So this is the head and shoulder bottom. The only difference is just this volume has to be confirmed. If this volume is not gonna be confirmed, it can be seen as a warning from us. In fact, this one it's very important that is gonna be achieved. Please take a screenshot of that, okay? this is important. I already told you everything as this is works exactly as the top. There can be some variation, guys, but please, I'm gonna go fast into it. I will do another video to talk about the variation, because I think for now it's enough. I hope that the concept that I told so far are good, but I think I will do the part 2 of this one. Please watch the second part of this video. Thanks.